Hey everybody, I'm Mark Levine. I really want to thank everybody for coming on to the Zoom. Thank you also for taking a Sunday morning with us. I know it's not easy getting up early on a Sunday morning and having to sit on a Zoom, so it's really appreciated. As I said before, when you came in, I left the microphones off just for now. If you want to put any questions in the chat, feel free to. We'll be monitoring that, both Avi and myself. And Avi, I'll let you introduce yourself in a second. But as everybody has at least seen me at least once from the sign up of here, I am Mark. I have been in property management for a long time here in the city. And one of the experts that I deal with on a routine basis is Avi, and he's graciously donated his time for us as well. I want to thank you for that. And over the last how many ever years I've been doing this, it's primarily focused on co-op and condo buildings as well as rental buildings in the city. Pure management, third party. Really don't own anything that we manage. It's all for other entities, whether it's owners or boards of the same vein. So, Avi, I'll let you introduce yourself and credentials, and then we can get into the presentation that we wanted to share with everybody.
Okay, sounds good. Thank you very much. Good to see everybody. Thank you again also for coming out on a Sunday. I work Sundays this time of the year anyway, so it's not a surprise for me to be at the computer. But my name's Avi Zanjirian. I'm one of the partners at Czarnowski and Beer. It's the firm that you see here. I've been doing this since I got out of college, so almost since 2007, so almost 20 years. Um, Doing co-op and condo audits. Our firm does about 250 audits of co-ops and condos, mainly in New York City, a couple Long Island. But this is what we do. So hopefully, all the financial statements I've seen over the years, I could throw some tips out to you for what you're looking at.
And I appreciate that. And I think the what we wanted to go through was to go through two different versions of a co-op, or one of a co-op and one of a condo. I understand that there's
Right.
different levels of experience with everybody in the audience, so we'll try to pare it down, and we'll also go through some of the differences. And I'll do a separate class completely on the differences between like what's a co-op, what's a condo, so that'll come up in the future. But where I want to call out are different points of the financial statement as it relates to like the specific makeup of each of these things, and maybe why some things appear on one statement, why they don't appear on the other. And then go through the notes that Avi has built out with that goes as part of that. And I know that, as I said before, not everybody is interested in a co-op or condo space, but this is helpful as a potential purchaser in the future, or if you do own something that's already there, even if you're not on a board, it's helpful to understand the workflow of what this information is, what it means, where it comes from, and then that will also let you make an insightful decision if you're looking to purchase somewhere and maybe it's a little bit of a questionable, audited financial statement. So with that, Avi, do you want to share your screen? I gave you capabilities to do that
I
uh,
can. Yeah,
as a co-host, so we
absolutely.
could walk through it.
Absolutely. So let's do that. And then we can flip back and forth between the two. I think this is the here.
Okay, great.
It's coming up okay for you guys? So we
Yep,
can see we have on one tab we have the co-op, and then on the other tab,
great.
actually move this way the condo, but this thing's in the way. Okay, oh yeah, move it away. Okay, great. Between the co-op and the condo. You can see both when I flip between?
Yes, sir.
Okay, awesome. All right, so just again, just there are some differences. As Mark mentioned, he'll have another class for like the main differences, but I think the important thing to understand is that when you look at a co-op and condo financial statements, when the version you're seeing. I think we get a lot of times a misconception that like we're behind our firm or any auditor is the one making the financial statement. So yes, we are in this industry, which is not doesn't happen in most industries. Are in this industry we are kind of formatting the financial statements together, but we're not doing the books and records. We're not the bookkeepers. We're not the analysts for the building. That's Mark's job. That's Mark's, EBMG. They do that. They're cutting checks. We're kind of evaluating the different accounts, risk levels, and providing an opinion. So that's our main goal, which is again this page right here that you should always see on an audited financial statements is your independent auditor's report. That's right here. This is important. I just pointed out, we're not going to go through this. It's very boring, but if it's just important to know what level of service you got from the financial statements you're looking at. So the audit is the highest level. That means that we have an opinion. So you'll see here there's an opinion, right? There's basis for opinion, our opinion paragraph. And you want to see this, in our opinion, the accompanying financial statements, blah, 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 are according to GAAP, and you want to make sure that that we're coming up with what's called a clean opinion. What you might find in certain situations, I would say in the 20 years that I've been doing this, has probably happened once, where you have what's called a disclaimer of opinion, which means that there's an issue. So just make sure if you see that to read it, understand what's going on, and ask questions, because the information that we provide here is important for the user. We're doing it right. The reason they're hiring us to audit and give an opinion is for I don't know if everyone here, but anyone that wants to buy into the building, anyone that lives in the building, the lenders, etc. So we're doing that to kind of communicate information. That's the point. And obviously people that don't have financial backgrounds get a little weary. Oh, there's so many numbers I don't understand. But so hopefully through this presentation we'll say, okay, let's look at these key areas, and you'll be able to ask the right questions that you need to. So then, this is an audit. What else could you see? You would see what's called a review, which is a step down from that, which means we don't give an opinion necessarily about the materially misstatement of numbers, but we do an analysis between last year and this year, budget versus actual. There is some thought process, as we say, into the financial statements. And the lowest level is called compilation, where as it is, we're compiling. We just compile the financial statements the way they are. We don't really ask any questions, and there is no opinion. There is another level below that called the preparation of financial statements, uh, like some nuanced differences, but we're not going to get into them here. Just understand those are the three main levels: an audit, highest; review, middle; compilation, lowest. And understanding what you're seeing in the opinion. So that's the first thing you should see. Um, so now if we go through, we're gonna kind of scroll through this. Just to give you like a basic understanding, what you should see in a financial statement is a balance sheet, which would list all of the assets and liabilities. Well, sometimes it's on one page, sometimes it's on two pages, depending on how many you have. And then you're going to see what's called another section called statement of revenues and expenses. That's your income statement, how much money the building brought in, what were the expenses for the building. And then you'll have a page called the statement of cash flows, which is going to go through kind of all the cash transactions. So on most of the financial statements that we prepare are GAAP financials, which means they're accrual basis, which means that not necessarily the money that came in or the expenses that happened on the financial statements happened in that year. It means that you incurred them. So if someone you build everybody maintenance, you build everybody common charges, you build rent to the commercial unit, whether or not they paid it or not, it's going to be there. You could detect from the receivables whether or not it was paid. That's what's called accrual. So on the statement of cash flows, it gives you a better synopsis of, let's look at this, a big line item here called net increase or decrease in cash. How do we do overall? Did we have an increase or a decrease? And obviously you want to see an increase or at least a flat line. You want to make sure the building, whatever's coming in is going out. But that's the area, if you're not understanding what's going on in the statements, maybe take a look at the cash flows and say, oh, how did we do? Did we increase cash? Did we decrease cash? And this explains to you how you got there, which also could be complicated, but also if you maybe after this class you'll be able to understand a little bit more of what's here. So that's the statement of cash flows, and then after that, the most important part of the financial statements are the notes. And the notes kind of tell the story of the financial statement. There's a lot here. Gives you, note one usually just tells you about the building or the organization, when it started, how many units, stuff like that. In case that's information you don't know. That's kind of when I get a proposal for a new job. That's the first note I look at. How big's the building? What are we dealing with here? And then I flip back to look at the statements. And then I would, you kind of see different things we could go through here. A lot of different notes that talk about assessments that might be going on, rental income, loans, etc. All that is a picture. Again, it gives you that picture of the statements, and then the last things you'll usually see, I guess, at least the ones that we prepare, We have more supplemental information, so we'll have a little bit more detail, some of those bigger line items at the beginning of the financial statements or an income statement. You want to know what's involved, what's the detail there, so we'll break that out for you further here. It's not part of the audit, but it's a supplemental information. A great page we love to put in, and we use it for the audit, is the budget versus actual, making sure we see how did we do compared to what we thought we were going to do. So if you live in a building, they set an increase for 5%. How did they get there? That's the budget. That's this column here. And then what actually happened and how'd you do versus the budget? It's always important to see how the building did versus the budget. And then lastly, then another piece of supplemental information that we provide is just another a pie chart, just another way to look at it. So those are the kind of the high level things you want to see: balance sheet, an income statement, a cash flows, notes, and then sometimes you'll have supplemental information depending on the account and depending on the building. So that you'll find in both a co-op and a condo. So
Okay.
you want to stop
So,
me?
yeah,
Yeah,
if you want to jump back up to the first sheet of actual numbers, probably
sure.
does that be the balance
That's what I'm
sheet,
gonna do.
right?
Yeah,
Okay, so like when we're talking about the differences, and we'll go through co-op after, but so as you said, we're doing, as we're a professional management company, is doing the books, presenting all the information to you as the auditor. It's now up to you to verify that what we're saying is truthful and correct, and through the backup and through the bank statements, through the records and the checks, that all matches up, or should match up.
should have matched
Um,
up. Yeah,
in a condo, it's a little bit different than a co-op, right? Because it's just on the ownership entity side. Each you could have a co-op building and a condo building that are the exact same structure, like the physical structure of it. But when it comes to how these pieces are owned, it's completely different, because a condo is what's a fee simple interest ownership structure. So it's different in the sense that all the owners own their own apartments. It's real estate, and then they also own a percentage of the general common interest. So they own a part of the hallway, they own a part of the common space, and based on the percentage of their common interest is how they're billed their common charges and how that's laid out.
right,
Typically, what we're not going to see I mean, you may see it sometimes as a loan, but you won't see an underlying mortgage on, if that's for the condo, because the condo itself doesn't own the building in the same way that a co-op would. So we're
right.
just going to structure some of these expenses a little bit differently. And just off to the side, when we get to the co-op, we'll bring it up again, I'm sure. But the condo, the common charge and an income that we are getting from the unit owners does not include the real estate taxes. In a co-op, since the corporation owns the property and you don't really own the property, you own shares in the corporation that allows you to live there, and you own a portion of it through shares. But because the condo is, you own your space, you get your mortgage on your property. There's typically no mortgage on the underlying property, which is controlled by the condominium association, but not owned by the condominium association. Those are two key differences.
Right.
So do you want to walk us through a typical, I guess, income and expense, or how would you walk us
Yeah. No,
through
so well,
the bar chart
I
ahead of
guess
you?
let me just piggyback off what you just said. So, in terms of like those two nuances, in terms of so here we're looking at a condo statement. So on a balance sheet, what you're seeing here for this building specifically is there is really is not going to be any fixed assets. There's no, because like Mark said, you don't the condo doesn't own the building. Each of the individual shareholders, unit owners does. So the only asset you see here actually was in 2024. This building specifically purchased a unit. There was a unit for sale. They thought it was a good deal, and they wanted. I don't know if they're. I don't. I'm not. I don't remember the details if they're going to plan on flipping it or they want to use it for the resident manager as a second unit. I'm not sure, but they went and purchased this unit, so that became an asset to the association. The condo bought an asset. That's the only assets that's here. But most condos, especially ones that were built before 2000, even the resident manager unit, the super unit, was given to the condo. Now the sponsors have gotten a little bit smarter and they make the building buy the resident manager unit, so you will have an asset on the books for the resident manager unit. But I would say older condos, you're not going to see that at all unless they actually own, let's say, or maybe you'll see some gym equipment if they have a gym or any, furniture and fixtures for the building. There really shouldn't be any assets because the association is an association. It's not a corporation. But if you let's flip over to the co-op for a second. In this case, here you have a whole fixed asset section. $81 million. It's a big, building. This building's on the, east side. So this was, again, this is not what the value is of the building. I get this question a lot. How's our building only worth $50 million? It's like, well, this is what the building was worth when the building became co-op in the 80s or whatever year it was. The way accounting for in the States is that you the it's cost basis. So whatever you paid for it, that's what's, so the building was $58 million between the land and the building in whatever 1980 something. The improvements, so any facade work or elevator work or roof work or any physical increase enhancements to the envelope of the building or the structure inside, that's something that increases each year, and that gets added. So this $22 million just means that over the life of the building since 1980, there are currently about $22 million of improvements that have happened to the building. And the advantage here also is that in a co-op you have what's called depreciation, which is it's not a real number, but it helps you for a tax perspective that helps offset any income the building may have. So this is something you'll see, you see this in a co-op versus a condo. Is the condo worth $58 million? Like Mark was saying, a similar condo? Yeah, it probably is, but it doesn't matter because the co-op itself, the building, the condo doesn't own the property. Each of the individual shareholders does. And that's why, as Mark said, just to kind of just keep on the same topic, when we look at the income statement for a co-op, you're going to see a real estate taxes number. In this case, it was, $5.4 million because that's the building's paying taxes on that property. If we flip back to our condo example here, you don't see any real estate taxes except for down here at the bottom, $11,000 for now they're paying real estate taxes on that unit they just purchased.
Right.
So they
And
have
the
a
individual unit owner would have their own real
correct,
estate tax bill from New York City in a condo because they own it's a block and lot that they have ownership of.
right. So you get your own tax bill in the mail, you pay that individually, and that's not it's not run through the condo. So yeah, so that's a major difference. So you'll usually see in a condo. So now we're looking at an income statement. So we have revenue here at the top. So all these are different sources of revenue. So I always try to tell people, see what other supplemental sources. Are you the owner? The common charge is the sole participant in funding everything for the building. And in this case, it's pretty much yes. As you can see, there's some electric sub-metering, but that's for the commercial unit. There's some rental income now that they have that unit, which again is small. And the other income, I imagine we'd have to go look at the supplemental, but it's probably some interest income. So in this building, any cost increase that's there is not going to be offset by a commercial or a transfer fee or move and move out, a significant move and move out fee. Really, the burden is coming on the owners for everything to be paid for. And again, I would say, I don't know, Mark, I think that's 75% of all the buildings are like that. And, I would say another 25% have other sources of revenue. Buildings have to get creative if they don't have commercial space to find other ways to kind of, give yourself a little bit extra breathing room. But most of the buildings are going to have, especially if it's a strictly residential building with no amenities, it's going to be a very clear, revenue source, which are the shareholders and the owners.
Yeah,
Um,
yeah. So the common charges are typically when we look at it, we look at it as revenue from common charges, or it could be revenue from an assessment. The common charges are typically built out of the normal operating expenses of the condo or the co-op when we're on that side of it. So that would be all the expenses that you're seeing below, right? It's the payroll and related, it's your energy costs, it's your repairs and supplies, your water and sewer, your management fees, your professional fees, the insurance. And as you can see, year over year, this is historical. So this goes back essentially 3 years from where we are right now. So it's 2023, this version, to 2024. Over the years, especially over the last 2 or 3 years, we've seen jumps in a lot of different areas of expenses. So when we're looking at trying to control the cost of the building, again, you're only getting revenue from, most times it's like an internal feedback. It's a loop. You're a closed loop system. essentially you're getting revenue from just the people that are inside the building. So you could bring in common charges. If you own your laundry machines, you could raise your laundry costs, but then that leads some people to just ship out laundry, so you have to be careful of how high you make things, but it also has to be realistic to the budget that you have. Some of the costs that we've seen that are going up, of course, if you're a union building, you have the payroll and related expenses are kind of tied into the union contract. So those are the things that you could at least anticipate. Maybe what you can't anticipate are overtime costs when you have major emergencies and you have call outs and somebody else has to cover a shift. Energy is kind of over the map right now, between electric, oil, gas usage, and different buildings do different things to try to counteract the costs and process there. Or they could try to lock in if it makes sense. Some buildings run on a temperature controlled, which is like you run gas all the time, except when it's below 18 degrees, the utility automatically switches you over to run oil. So you're hoping to get a better price with the gas company because you're saying, yeah, we'll play ball. We'll move over to oil when it makes sense for you, and when the system can't handle it. And in return, we'll get a better rate from the utility for those times that we're actually using gas. Um, Repair supplies and maintenance. That's something if you look even here, and I don't know anything about this building, I don't know where it's located, but this is kind of in line with what I'm seeing. The jumps of year over year, and when we look into the past year or two with costs of labor, that's gone up. Cost of materials has gone up. We went through the tariff situation where the Supreme Court weighed in on it, but guess what? All the tariffs that were put into place over the last, year have affected our suppliers for vendors because they don't know also what those costs are going to be day to day. So there was a lot of fluctuation in the market between the cost of the actual materials, and then there were the cost of the labor that's gone up. Water and sewer is pretty much tied in with normal increases with the city, but I will say if you're living in a building, if you're on a board, make sure that you have systems in place to monitor leaks. Especially, this is tied into larger discussions, but if you're looking at it from a local law 97 point of view, where if you're in a building that's greater than 25,000 square feet and you have a requirement to reduce your carbon emissions, and your energy grade has to be kept in a certain way, water use is tied into that number. So just from a normal operating, if you have a boiler system, and this is assuming that you're not just a tenant that doesn't have access to this stuff, but if you're in a position of either being a landlord, if you're on the board, if you're a managing agent, just make sure that you have the systems in place to monitor leaks that are coming around the boiler. Maybe you have some boiler systems like a US Energy or a Runwise that really maps out not only the boiler's health, but if you have water loss from leaks and steam leaks, you can kind of track that out. If you have any leaks inside your unit, whether it's a running toilet or a running faucet or your shower body is leaking, like all of these things, and if you multiply that by 60 units or 100 units, it adds up dramatically. So those are the things that you're going to want to watch. um, the other things, where we're at, again, a condo doesn't have a loan. Sometimes they have a loan that's either backed up against the income of the common charges. If the building needs money and they can say, okay, here's our receivables, that's the collateral. Or in this case, I'm sure, Avi, you've seen it before, where if you have an owned unit by the condo, because it is real estate that the condo owns, they could get a loan that has the collateral of that. Maybe it's a super's apartment or
Yeah.
something else. You really can't do it on common area. So those are just things that we're looking at. Insurance is the big driver too. This isn't so bad, 78 to 90, but over 10 to 15 to 20% year over year increases in insurance is not out of the question right now. What we've seen is a hard market on insurance. So year to year, it's gotten pretty bad. And if you have any losses on your buildings, they look at 5 years of historicals anytime that you go out to bid. So just my 2 cents on this is, if you're with an insurance company and you're in a position of this, again, we have a variety of people on here, but if you're in a position of reviewing insurance brokers and carriers and, year to year policies, just know that if you switch too often, that really negatively affects the building, because the insurance companies don't make their money off of the year one and year two when they're with you. they make it over a 3 to 5 year plan, right? So if you're shopping, you're going to knock yourself out of a lot of markets because they're going to say, oh, well, we're not going to make back our money. We're just going to decline to give a proposal. And the other thing to look at is like your historical losses and your umbrella and coverages. I have some buildings where they've just had leak after leak and flood and issues, and suddenly your deductible goes from 10,000 to 75,000 in order to keep your premiums where they can be digestible, but you're eating all that cost. So where you can, just try to make sure that you limit your exposure as much as possible and keep your loss, possibility as low as possible. Okay, that's my 2 cents on this page.
No, that's great. That's great. You're behind. I only get to see them after the fact. You live the numbers day in and
That's
day out.
true.
But the one thing I wanted to add here is that we see a lot of, I would say, the stat, which again I was just doing it based on memory, but of the 250 buildings, I don't think there's been in a scenario where a building has not done an annual increase of maintenance or common charges. It's never on a consistent basis for X amount of years. Because so, for example, if someone says, "Oh, in our building we don't increase common charges or maintenance," except for one building, which was in Long Island, and actually they were ahead of the curve on in terms of natural gas heating systems. That has always been made a true statement. Yes, they haven't done increases, but it didn't end up being and it didn't end up with, a big explosion at some point of, oh, we have to do a 20% increase because we haven't done one for 10 years. It's very common and it's also recommended just because, like what Mark was saying, if you're a union building or even if insurance now, there's going to be a percentage uptick just in terms of inflation that you really need to put into account. If you have major savings one year because you implemented a new system or you saved a lot of you were literally wasting money in water and you figured out a leak issue, fine. But consistently we have buildings that say, we can't raise more than this and we can't raise more than that, or they're gonna the shareholders are gonna, whatever, they're gonna kill us if we do this, and the board obviously they pay it themselves. It never ends up working out for them that they don't do the increase, because again, the money has to come from somewhere and the money is going to come from the shareholders or the owners. So to hear a building saying that, we haven't done an increase in 7 years, I'd be weary, and I'd look at those financial statements. How does that look? How do they look? And where I'm getting to is the line item I look at is this line item right here, which is I mean, we call it, it's very wordy, excessive deficiency of revenue over before other items. But this is pretty much what's your net income for the year? How'd you do? Are you running a profit? You're running a loss. Because buildings that we have that don't do this, they're consistently running a loss, and they're consistent. And where are they getting the money from? The reserves, or from areas that they were going to use it for other projects, and it becomes an issue because then you don't want to necessarily, I don't want to say you don't want to be in a building like that, but that's something you should be raising a question for. And if you're buying into a building like that, and that's what's going on, maybe you think twice, because it really is. You want to make sure that you're not putting yourself in a position where it's being run that way, and then you're going to be getting hit with some big assessment at one point or some massive increase later on.
There was only one instance of a building that I could think of that didn't do increases years at a time and it didn't affect them. And it was one building in Brooklyn that was an old HUD co-op. So the way that they had structured their flip tax was, if you were there, and there were a lot of people at this time, if you were there prior to like 1985 when they went co-op, you had an 18% flip tax when you sold, because the theory
Right.
is there you got in so cheap that when you sell it's a windfall, so the co-op will get some of that. So there was a large period of time where if you were selling off and they had a huge amount of apartments, and this was in Windsor Terrace in Brooklyn, so they were going for a really nice amount. So that was funding the building for a very long time. I mean, a lot of sales. And then suddenly you get to the point where now it's turned over. The majority of them are post 1985, or I think that was the benchmark, and they're at 4%. So you have the 4%ers, you've got the 18%ers, and suddenly as the tide shifts, as the proportion goes way up for the 4%ers, and you're stopping, getting that 18% in all the time, you're going to have to now start to go the usual route of just raising maintenance so that you do it. The other thing that I would caution is if you look at a building and you see that they're covering their maintenance increase, or they're covering their operating common charge, revenue, with assessment after assessment after assessment, that's almost the same thing in lieu of a common charge
Increase.
increase or a
Yeah.
maintenance increase. So, just when you're looking at these things, and if you're ever purchasing, or if you're just kind of like figuring, where the money is laying, sometimes you just have to look outside the box and see, are they covering their expenses with other things? And assessments aren't as predictable sometimes as common charge increases. When we do our budgets, we try to have a zero net out. So we try to say our income is matching our expenses. How could we do this through normal operations, through normal common charges, or maintenance if you're in a co-op, as opposed to having to go back to the well? There's always going to be points where you have to reallocate expenses, and you see like, okay, we're halfway through the year. What's that look like? But from the year forward, from January 1, we should have a pretty tight ship, without any emergencies popping up. Um, I did have a question in my head that I was going to ask, but I don't remember. It flew out of my mind. So
All right,
I
we'll
will
flip them
let you
back.
go. Yeah.
No problem. Yeah, yeah, I'll add the other thing I'll add to that is also if you're seeing that we have some properties that use transfer fees. So Mark was talking about like those that's a very special situation,
Like a flip tax.
of a
Yeah.
flip tax, a transfer fee that are being utilized to offset increases. Again, you're allowed to do it. There's nothing wrong with it. However, transfer fees and flip taxes are usually a mechanism to build reserves, right? So you have a build, someone, again, just to give you the basics in case you don't know what that is, if you're selling your unit, a lot of co-ops now will charge, let's say 1, 2, 3, 4% of the sales price as a transfer fee to add to the reserves of the building. So the reason using that to offset operating costs is a twofold problem. A, that's not predictable. So if you have $100,000 hole in your budget, oh, we'll use it for flip taxes. Well, do you know you're going to collect that this year? But what if the market dries up and there's no sales? What are you going to do with that 100,000? So that's number one. And B is that it's an easy way for the building to add money to its reserves to offset future capital projects, because that's something you want to be thinking about too. Anything Mark and I have just been talking about is really operating just day to day. You also have to, there's a bigger picture of capital, which hopefully we'll get to in the session, just to touch on briefly, where you have to think about, okay, well, what am I doing about a roof or an elevator or a facade? New York City, you have FISP, the local 11 facade inspections. How are we funding that? It could, in a co-op, it's easy. Oh, I have a refinancing. We'll just take out more money. Great, fantastic. That's an approach. But with condos, so Mark mentioned, I brought this condo specifically because it is a condominium that actually, if we're gonna, now we'll jump to the balance sheet for a second, that actually has 3 loans. So it's very uncommon for condominiums to have loans, but it's becoming more common now because condos are, they need to go through these big facade projects or any capital projects. There's a lot of riser issues going on in the city now for these buildings that are over 100 years old. So the risers need to be replaced. And that's, you can't assess a building, this building's, I think, 50 or 60 units. You can't assess them $2 million. I mean, some buildings you can, depending on where you are, but most buildings don't want to assess everybody $2 million in one shot. Let's borrow it. So in essence, what the condos will do is they'll take out a loan, and they're pretty much taking out a loan for the unit owners. So it's one lump sum loan, and then everyone pays it back through a capital assessment over 10 years or however many years they decide to do it. So in this building, they had a loan, and then they had another project that came up after. They had to take another $2 million loan here as well. You see loan one and loan two, and then the promissory note was specifically, they actually, going back to what we were talking about, was purchasing that unit when they had a unit that they wanted to buy. So they took out they also have a note just to purchase that. So it is a little bit more. I'm bringing this up just because it's a little bit more involved, just to show you what you might see. Most condominiums, I would say at this point, I would say 70% of our condos don't have loans, but it is becoming more common
And
because of
they're
the work that
usually
needs
at
to be done.
higher interest rate because there's no
Yeah,
collateral. So
correct. Right, exactly. Condos are also getting higher interest rates. And you'll see here in your, we didn't get to this yet, but in your income statement, we have this designated fund capital. So this has all of the capital transactions that go on during the course of the year. And these are, you see they're assessing for the loan. This 333 and 262 offset the loan payments. There's loan interest that they're paying. And then you see all these capital projects the building went through, close to 1.6 million over the last 2 years. That was all funded by the loan.
I
And
remember the
that
point that I wanted to make, Avi. Sorry to
good. Okay,
interrupt.
good. Good.
Okay,
I was just trying to buy
you're
time so
giving
you
me enough time. Yeah, I appreciate it. My
could.
wheels are spinning. One of the points that if you go back to the expense and the revenue where it had the expenses of like the insurance and all that. So let's take the co-op and condo out of it because this looks very similar in a co-op and a condo. So I think that we could look at this item and say, yeah, this is relatively, on par. But if you're a resident in a tenant in a rental building, I know you don't necessarily see behind the scenes of this, but this is just as valid for a rental property as it is for a co-op or a condo. So when we have, and this is not political in nature in any way, I have no skin in that game. I'm just saying when you have a fixed income coming in from a tenancy there, and you know that okay, over a year or over 2 years, I'm getting 2% or 3%, whatever that is. You can see that from a perspective of our increases here, the increases stack a lot higher than the revenue that we could get by if we renewed every lease, subject to what we're allowed to by law. And that's not a concern of the tenants, that's a concern of ownership, of course. But you can see that sometimes, and especially in the environments that we're at now with the mortgage rates, if it's also a time that the building has to restructure. I have a lot of buildings, whether they're co-ops or whether they're rental buildings, that have 3%. I think there was one that I saw at 2.75% recently. If it's time to refi, you're looking at a jump up to probably now the 4-year treasury is around 4-ish%. So let's call it high fives to 6% on on a co-op. You're completely, changing the dynamic and that flow of how much are our expenses, how could we afford it, and then that gets into, the ownership and having to go back to their partners for capital calls because all you need is one problem in the building to shut down the cash flow. And that could be a leak, it could be a boiler issue, it could be a facade issue. It doesn't matter. It could be $5,000 or it could be $500. If the building isn't set up to take in enough as their expenses keep growing, um, that's something that they have to work on, and that might see a shift in some way about ownership entities and who is able to buy these buildings in New York City in the future and how they're going to figure out tenancy and different cost structures. So that's just something to look at from your end. Okay, I'm good.
Okay, great. So that is a great point. Yeah, the same expenses. But one thing you're not seeing here, and which has become more common in condos, is that a lot of condominiums right now will have a line item to allocate a portion of common charges to reserves, about 10%. So in 2010, um, after the banking crisis in 2008, the Fannie Mae sent out guidelines that they wanted to see condominiums allocating 10% of common charges to reserves to help build the reserve fund. A lot of buildings have implemented that. A lot of the newer condos that have been built since 2010, their initial budgets have that already built in. And I could tell you from a lot of the new developments that we've started auditing and then have kept as part of our portfolio over the many years. That 10% really grew because they were doing it consistently. So in this case, it was you have a $1.5 million budget. 10% is $150,000. Putting away $150,000 every year, that really helps offset projects in the future. And this one building I'm thinking about in Park Avenue, there's another building I'm thinking about in Brooklyn that did this And then when start things start to break, and then, or things that start actually to break to deteriorate, right? Everything has a life. They had reserves to offset it, and they didn't have to go to the owners for these major capital assessments, and didn't have to go to the banks necessarily. So it's something that so this building doesn't have it. This is why they have to go to the loans. And again, we took it on, later on it's an older building, so they never wanted to implement that 10%. But the point reason I'm pointing this out to you now is because if you see that or you don't see that, one of the questions you should be looking at when you're looking at a financial statement is, how is cash? And that's going back to our balance sheet. And you could see in this building, it's pretty bare bones. And they have about $200,000 in there between, cash, their operating account, and then their restricted cash down here, which is set aside for capital projects. It was solely built on the loans. So had they not borrowed the money, this wouldn't be there. So they're not necessarily, I should say all of it. If anyone, I don't know, no one knows which building I'm talking about, but in case someone on the call is from that building, a little bit of it was from something else, from a settlement with a commercial tenant, but most of this money is from loans. And if you're looking at a condo financial statement, looking at the how much is in reserves is an important thing as well, because that'll give you an indication of, oh, they have nothing. They may have a project in the next 5, 10 years, and they're probably going to assess for it.
Can
And
you
just
jump
being,
down?
yeah,
Sorry, to finish this point, because I want to talk to you about this.
sure.
And I'm sorry for interrupting you.
No, no,
But
absolutely not.
it's hard on Zoom sometimes. Can you jump down to the note on the capital improvement study?
Sure. So yeah, I will definitely do that, and I'll show it to you in the notes too. But
Okay. So what Avi was just saying about the Fannie Mae requirements for 10%. Technically speaking, a building, and this does not apply to co-ops, this only applies to condos. If a building has done, so if you look at note 15, and this is in every financial statement for a co-op or a condo, and this is one of the more important components of when you're looking to buy into a building, how you like figure out like what's going on long term, and and you could ask these questions, of course, through your attorney, through your broker, whoever is dealing with the management company. So it says here that the condominium's governing documents do not require the accumulation of funds to finance estimated future repairs and replacements, which is normal because the 2010 came out the 10% law from or requirement from Fannie Mae. Most of these offering plans and condos that we're seeing are from like the 80s and 90s, so it predates it. So you see the next paragraph. The condominium right after that has not promulgated a study to determine the remaining useful lives of the components of the common property, nor estimated the cost of major repairs and replacements that may be required in the future. So the way around the 10% is if the building had gone through an actual study and had finalized it and laid out the cost and released that to the unit owners, that would be a way of sidestepping the 10% requirement, because you're laying out the cost of everything coming up and everybody purchasing, everybody owning, they know what's coming up. But there's a few different ways to look at this. I don't recommend it, keeping it there. I would much rather have the 10% holdback, because there's a few reasons why. When you do this, if we do this, we always leave it in draft form. So it's more of an internal document that's living and breathing for the board and for management. If you finalize it, that's being used by a lot of people to potentially buy into the building and say, if we did a study back in 2015 that said, oh yeah, we're going to need $1 million over the next 10 years to do X, Y, and Z. But then when we actually are looking to do that in 2022, 7 years later, out of the 10-year projection, because of all of the issues in the world that have popped up, labor costs going up, materials going up, just, whatever. What if it's 3 times more than that? So you've bought an apartment subject to information that was maybe not wrong at the time, but it's wrong now. And could you theoretically go after the building? Potentially. I've spoken to lawyers about this. I've spoken to accountants about this, and we've all agreed it's probably not in the best interest for the long-term view of the building. So when you're looking at it, if you see this note and you're buying into a building where you live in the building, I'm not scared of that note. I prefer that note because it protects the building. But I would have the discussion with the managing agent or with the board to say, okay, I understand that you haven't mapped out the future repairs, but can you let me know what the roadmap is? And they should be able to answer, if it's a well-managed building, what the roadmap of those upcoming projects are over the next 5 to 10 years, and if there's any expectation that there will be an assessment for it, or if that's going to be, maybe a long term. We can do compressed assessments, which is not ideal, but if you prepare, you could do a long-term assessment for a capital project and spread out the time so it makes it a lot more palatable for everybody living in there. Because with all the other expenses of just normal operations, with the common charges or the co-op maintenance side, then that is a problem if we also have to then add on an unknown quantity of assessments from time to time. So we want to keep it as tight as possible. Okay.
Yeah. And then and some and that's people ask us the question of like what's a healthy reserve, which yeah, I love the question but hate the question at the same time because there's no right answer. The bare bones answer is you want to maybe try to have 3 to 6 months of common charges in reserve as a metric because people if you want to see a metric. But really the answer that we like to give is what are your capital needs in the next 5 years? And if you know what those are, and how much do you have in reserves compared to that, and how are you getting there if you're not there? That would say whether or not you have healthy reserve. Oh yeah, we have a $2 million local law 11 project coming up in 3 years from now, and we have $3 million in the bank. Oh, great, fantastic. That's healthy. If it's the other way around, then not necessarily it's not healthy, but what's your plan? Oh, we just started a 5-year assessment to accumulate the funds, or oh, our mortgage is going to be due in 2 years. Perfect timing. We're gonna finance it. Hopefully, our interest rate's 3% now. It's going to go up to maybe 5 or 6%. So we understand there might be an increase in maintenance, but an increase in maintenance of 4 or 5%, pales in comparison to a $2.5 million capital assessment paid over 10 year. I'm sorry, 10 months or 6 months where you're paying all that up front. So those are the different kind of questions. And again, I think the idea of this call is to kind of give you the background to ask the right questions to ascertain whether or not you should move into a building or not. The goal isn't to say, oh, you shouldn't move into a building like that. It's really to kind of set yourself up for, oh, I'm coming into a building that has a lot of work coming up. And that's fine. I really love the building. I really love the area. It's a good price. I want to move there. But I know that I'm going to be, potentially being asked to contribute to these capital assessments over the next couple of years. I'm ready to do that or not, as opposed to being, the element of surprise. Then
Okay,
one
I'll
other
go
thing,
over.
just, yeah,
Oh,
sorry.
sorry, you
Yeah,
finish.
no, 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 no. I was
No,
going to go to a different topic. So go, continue.
I was going to go to a different topic too, but your topic may be more relevant. I was going to go over to the co-op side and just like touch upon maintenance, how it incorporates real estate taxes and the mortgage,
Yes.
but also
Okay.
how that leads to the tax deduction letter and to the 1098 form.
Absolutely. So I'll give you one more piece of advice put for the notes, only just because we had a client that came up recently, and I think it's just something that it might be out there. When looking at the notes of the financial statement, also ascertain if the building owns its land. There are some, it's not common, but there's still enough of them out there that the building you may not own the land that the building's on. There's what's called a ground lease. And in one particular situation, it's caused the potential that the shareholders are going to lose their apartments if they can't negotiate with the landowner. But again, this is information that's in the financial statement footnotes. And if you read it and you understand it, it's a question you may want to ask or understand, or say, oh, maybe I do want to stay away from this because I don't know how this is going to end and how my investment's going to be. So
There
just
was
again,
a there was a building on Central Park South that just went through this that was all over the news maybe a month or two ago. And it's the exact situation. The apartments were held very low in terms of their values because there was a ground lease and nobody knew what was going to happen when the ground lease expired. And I think it's a co-op. I believe their maintenance went up by like 400% because the ground
wow,
lease was
wow,
negotiated, and now everybody's kind of being forced out because they can't afford it. But that also should be in the disclosure with the questionnaires
yeah,
when you do
yeah.
purchase. So even if it's not in the
No,
body
it's
of the
right. It's
information,
right. There's a few checkpoints that should be coming up as a red flag.
Yeah.
But yeah, here. So I just flipped over to the to a co-op. So you can see in this building they have a little bit, a few other sources of revenue. They have this building happens to have significant commercial income, but if you take a look here in 24, there was a drop because this building specifically had an issue with its garage tenant, one of the restaurants. The commercial industry, the commercial industry in general. I think Mark, you could correct me if I'm wrong, is has been hurting, even pre-COVID. But it definitely had its issues during COVID. But this building specifically had an issue with its garage tenant, had an issue with its restaurant. They vacated. So when you're looking at this, in a building of this size, they lost like close to $400,000. I'm sorry, 300, yeah, $400,000 worth of revenue one year. Again, that their maintenance was tagged to. So while having a commercial tenant offset revenue is helpful, the question is also maybe how strong is our tenant? How long have they been there for? Is it Apple? Is it a stronger tenant, or is it oh no, they just moved in there and we've been rotating this space has been rotating year after year for the last 5, 10 years, and we've had to implement assessments each year. Again, just to kind of give you the idea of what's going on. But yeah, but if you want to go back to the point of that, the maintenance and the real estate taxes and the mortgage interest, I'm happy for you to take that on if you like.
Yeah. So essentially, in your common charges for a condo, right? That's only your operating expenses. That does not include the cost of the real estate taxes, because as we described before, it's a fee simple interest. You own your apartment outright. You get your own tax block and lot. You, as a person, pay it. But when you're in a co-op, sometimes when you're looking, if you had two buildings next to each other, a co-op or a condo, and you're looking at buying, you look at the monthlies. The monthlies are traditionally lower on the condo side because you're paying for the real estate taxes and you're paying also for the mortgage, for the underlying mortgage for the building in a co-op. So it looks higher, but there are certain devices that you have at your disposal every year that help to offset this. And one of the things would be that you could write off a portion of your taxes, your tax deduction letter. So your accountant, in this case, Avi, would issue the shareholders a letter, usually late January for the prior year, that
Yeah.
says, or February, based on your share count, it's X amount of dollars per share. So you take your number of shares, you times it by that value, and you give that to your accountant, and that's that's the dollar amount that you could write off. Am I explaining that correctly?
Yep,
In
absolutely.
a
Yeah, so you
nutshell?
get to deduct the interest and the as long as you're itemizing your deductions on your individual return, you would get the interest, and then the real estate taxes has been capped for the last since 2017 but in the current bill that was out, it increased the amount of what's called SALT, state and local tax deduction. Now it's up. I mean, depending on your income level, it could be up to, I believe it's $40,000 from the 10. It was capped at 10, now went up to 40. So if
Okay.
you're living in New York City, and real estate taxes are higher or anywhere in this area,
Yeah.
that is a little bit of real breathing room, as long as your income is within reach of this, which I think is about, I think, 250 for married. So it might not be a lot for some people, but
Right.
it has allowed people to deduct it more than they were in the past.
Okay. And the other thing that you could get in the mail from your management company if you own a co-op and if there's an underlying mortgage is the 1098 form, which tells you what your allocation of the building's underlying mortgage is, right? So
Right.
when people get that form and they don't have a mortgage on their own property, on their own shares, which is the collateral, because in a co-op, the shares is the collateral, not
Right.
the property, because there is no real property. It's just shares in a corporation. It's a proprietary lease that allows you, through the shares, to live in the apartment. That's the landlord-tenant relationship between the co-op and the tenant, the shareholder. So you
Right.
get a portion of the underlying mortgage of the entire building to write off. But the confusion always comes every year. I don't have a mortgage on my shares. Well, no, this
But you
isn't
get those
your
questions
mortgage.
also?
Yeah. Oh my God.
Yeah.
Yeah. All
I
the
was
time.
like, I can't complain then.
And you notice also here, there's the abatement assessment on the revenue side. So, if you are in a condo or a co-op, rather, you will see that there's a co-op abatement that is given out to all shareholders every year. And almost 100% of our buildings, because you can't just give out, in this case, let's call it $900,000, let's just round it out. The city is telling the building every year, you have to give this much money out to these shareholders that are eligible for the co-op abatement, for STAR, for veterans, for disability, and for seniors. But the building can't afford to just say, oh, here's $900,000 shareholders, because it's not coming from the city. It's coming off of a future tax credit. So they make you take it out of your cash. So in order to preserve the cash flow, we legally have to give out the abatement. But what we can do, and not everybody gets the abatement, but we have to treat every shareholder equally and every share equally. We will assess for the totality of the amount that we're giving out on the co-op abatement on an even platform to all shareholders. So we give out the abatement, we let you as the shareholder collect it, but at the same time, we're reaching into the other pocket and we're saying we're pulling that out on a per share basis because we can't afford as a building to operate on a $900,000 debt. The cash flow would just be completely underwater. So that's just something to look at. If you get the abatement and you get the assessment, that's just normal operations. And there are very few buildings that can actually afford and put into their budget the complete allocation of abatements out without assessing back in.
Yeah, I think of the 100 co-ops or so. I think only one or two actually
Mm-hmm.
just roll it in. But again, you're paying it through the maintenance. Either you're paying one or the other.
Yeah.
So
My
just
last point is, and
yeah,
I think we could, I know we didn't cover too much on co-ops, but I think it's mostly the same
it's
on
mostly
a
the
lot
same.
of what we talked about. I'm happy to do it another time. But one of the things that oh no, I lost my train of thought again. I have too many thoughts running in my head. I'll think about it in the meantime. But if we want to open it up for questions, if anybody wants to put any questions in the chat, I know we're running up towards 11. I don't want to go too far over because I want everybody to enjoy their pre-snow Sunday. Salt the salt the driveways and the sidewalks, whatever you need to do.
I just want to
But
make one last point, and just the difference on a co-op and condo in terms of looking at the bottom line, and then we'll go to questions. Is that we get this question a lot from banks, where it's they look at an income statement for a co-op, and they say, "Oh my gosh, why are you running such a huge deficit? At one point, you're bleeding cash, 1.8, 2.9," and I say, I'll say to them, "Well, you're not looking at the right section because these numbers include what's called, we talked about this at the beginning, depreciation and amortization. This is depreciation of assets, of the fixed assets over the life of the building. So that's not, yes, it's an expense that helps to reduce your taxes, but it's not really, that money's not being forked out, each year. That's just it's a depreciation. It's an accounting entry. Where you should be looking at is up here, where, before other items. I mean, not all accounts do it this way. Some accounts just lump all of them together. I think most accountants will say, here are operating expenses, and then other items will have include depreciation and some other things. This is the line item you should be looking at. Again, it doesn't look good either. This building was running an $80,000 deficit in 23 and a $200,000 deficit in 24. Again, specifically because of the commercial income issues. But that's the line item you should be looking at when you're evaluating. So we looked at it on the condo here as well, same area before other items. Sorry, here. So here's that, here are those numbers. And on the same thing with the co-op, you want to be looking at that area to see how's the building doing operations wise. So
I
that's
remember what
my,
I forgot.
yeah.
I just need
Oh,
you
it's
to
good.
remind
I
me in
like
two
this.
minutes, and I'd always
I'll
have
just keep
forgotten.
talking and you'll remember everything.
I'm like that fish in Finding Nemo that keeps forgetting. Was it Dory? When you're, and you could clarify this maybe more than I can, but when you are kind of doing your taxes, or no, I won't say that. When you're selling your apartment, if you've had capital assessments, you could add those units to your, you could add those assessments to your basis, right?
Yeah.
You can use that and you can offset the cost of what you purchased the unit for. You could add on those assessments that you've paid, and then you could use that to lower your taxable, like,
Right. The capital
exposure.
gains on your
Right.
unit. Absolutely.
All right. So let's go to the questions. I know that there were two that I saw at least. Jessica asks, are you required to list the apartment numbers that are in arrears? I've never seen apartments listed in arrears.
Yeah.
Okay, so no.
Yeah. I
And
don't think so.
is it
Yeah.
correct to confirm all the arrears will be collected when part of the total arrears will be collected during the, yeah, so coming from a sale point of view, whether it's a co-op or a condo. If it's a co-op, we don't allow the transfer of shares until everything is paid up. So we control the transfer through the attorney or through our office as the transfer agent. So that is done. On a condo, it's a little bit differently because we're not doing the closing in the same way, but every condo closing should have a common charge letter. So that tells the parties that are closing if this has been closed or if you're going to close, all the fees are up to date, all the assessments are up to date, and if they're not, we won't release that. So everything has to be paid up through there. So from a co-op or a condo sake, the management agent should be handling that. Um, what is lease settlements? Also, how do you address Section 8 units when you need to do an assessment? Do you have any context on that, Avi?
Well, I assume the question was referring because in here it said lease. So in this building, one of the lease settlement that was that million, it was $1 million number that was on the screen. I assume that's what you're asking about. They happened to get out of, yes, yes. So in order to get out of the lease with the garage tenant in this building, they had to pay the garage tenant $1 million to get out as part of the lease. So that was what that lease settlement was specifically in this building.
Okay,
But
and how
that's normal. That's not a normal
not a
transaction
normal
that you
thing.
see year in and year out.
And how have you seen Section 8 units allocated when you do assessments? Are they tied in the same way that other units are?
So I see. Well, so if you're having so I haven't seen
It's an
a.
HDFC
I was
building.
gonna
That's the
say it's an
same thing.
HDFC. So usually the HDFCs don't get the abatement because they're not paying real estate taxes anyway. Usually, I mean, or there's a phase out period. A lot of the yeah. So a lot of some of the HDFCs that we do work on. I think they're still in that grace period, so I haven't actually come across a Section 8 unit that would have gotten an abatement. So
Okay.
if they're right, because yeah, so I haven't come across it yet, but I would
I haven't
imagine,
dealt with that either.
yeah,
I
I would
have
imagine,
HDFCs, but not with the Section 8 component.
yeah. So I don't think that would happen. I don't think you would get the abatement in an HDFC. I mean, right, you wouldn't because you're not really paying real estate taxes, so I don't think that question really would ever come up.
Correct.
And if you
Correct.
do have that come up, then I guess we could talk offline if we're
Yeah,
having.
if it's an actual use case for the user that asked that question, just send me an email.
Unless you're asking specifically, how do you assess a Section 8 unit in general at a at an HDFC? But I guess that's a question for New York for New York City, if you
Yeah.
would, because you're only collecting whatever the city subsidizing the Section 8 units anyways. So that's a good question. I don't know. I don't know how you would assess them.
Okay. Any other questions before we jump? And I did record this, so I'll send a link to the recording for everybody who is here and who is not here. Give everybody 2 minutes. But Avi, I want to thank you very much for
Pleasure. Thank
walking
you.
us through that. I mean, your expertise saved me a lot of talking, so thank you.
No problem.
You
No
know your
problem.
stuff, so it's always
There's so
appreciated.
much. There's so much more. There's so much more. There's so much more. But yeah, maybe we could do another time. Or if
Yeah,
you,
absolutely.
yeah, we have. I mean, I know you have a lot of stuff on your account. If you look on our, Czarnowski and Beer, our YouTube account has also other informational webinars we've done. So if you want, more topics on
Great.
budgets or
I'll
financial
send out
statements,
links
that's there.
too. Yeah.
Yeah,
I'll and for those that are on here, I'll send out information. I'll send out the link. I'll send out our contact information so that if you have any questions, I'm always an open book with, please reach out if you have anything to, want clarity on. And I know Avi is very open and loves answering
happy to answer.
questions.
Just
But
realize it's the middle of our busy season, so we may
yeah.
not respond as timely as we would maybe in the summer. But I feel.
Management always has a busy season. I can't relate.
Yeah, yeah. Yes, if you ask my wife, it's always busy, but yes.
All right. Well, thank you so much, everybody. I don't see any new
Thanks
questions. So, Avi, I'll let you get on with your day as well. Enjoy the kids.
a
To everybody else, I really appreciate you taking the time and actually showing up. It means a lot to me. And I know Avi, it means a lot to him. We'll be in touch and hopefully we'll continue doing sessions like this where we'll have just free information for everybody. All right.
Okay. Thanks a
Thanks,
lot.
guys.
Sir.
Thank you, Avi.
Pleasure. Bye.
Bye, everybody.